All right, go right ahead.
Hi, my name is Tanya Johnson. I'm with Community Action Agency, the VITA program. Now, VITA, let me just give you a little bit of information. VITA, it's a free tax preparation program that we run. It's under Montgomery County's, as I already told you, Community Action Agency. Now, we prepare free tax returns for Montgomery residents only. The income has to be $58,000 and under, and we're actually through a program that is through the IRS. Now, VITA stands for Volunteer Income Tax Assistance Program. This program is staffed with trained and IRS certified volunteers. Our particular program will be starting back next year, and we will have a virtual model. Plus, we're going to have 3 locations with weekly services in Gaithersburg, Rockville, and Long Branch. We're also proposing to have pop-up sites for East County, Germantown, and Wheaton. There is a website, which is www.montgomerycountymd.gov/cashback. That website has a lot of information about the free tax software. There's information there about free tax preparation resources, informational webinars, and more. So if you ever get a chance, please visit that website. Now, when you come into our site, you will definitely need to bring a Social Security card or an individual taxpayer identification number, or we call I-10, for each family member. Now, keep in mind, those Social Security cards have to be the original. They cannot be a copy or duplicate. The I-10 has to be a letter, the actual letter. You'll need to bring a valid government issued photo ID. You have to have the birth dates for yourself and your family, all your income statements, child care, elder care, and health care information. If you're married and you're filing a joint return, both of you have to be there. If it's separate, you will definitely need to bring and get the information from the other spouse's Social Security number, the name like it's spelled on the card, the Social Security number, and the date of birth. Now, some basic reminders. This is called, we have the standard of conduct. You must follow the quality site requirements, or the QSR. You do not accept payments, solicit donations, or accept refund payments for federal or state tax return preparation. You do not solicit business from taxpayers you assist, or use the knowledge you gained, their information about them, for any direct or indirect personal benefit for you or any specific individual. Please do not knowingly prepare false returns. Do not engage in criminal, infamous, dishonest, notoriously disgraceful conduct, or any other conduct deemed to have a negative effect on the VITA TCE programs. You treat all taxpayers in a professional and courteous and respectful manner. All volunteers must take that volunteer standard of conduct training. You must pass the test. You must complete the form 13615. You'll sign it and you'll date it, and you'll send it in to Mr. Eduardo Mendez. You're going to complete the intake, interview, and quality review training. That is most important, because that quality review and intake training is going to help you to prepare an accurate return. You must pass all of your certifications with an 80% or higher if you're going to be preparing tax returns. Now, VITA has a scope. There are returns that we can do, some we cannot. We can only assist with returns, supporting schedules and forms for which we have been trained and certified in. Taxpayers that are outside the scope of the VITA program, you must contact your site coordinator, let them know, and then they will proceed with it. Now, there are 6 IRS tax certifications: Basic, Advanced, Puerto Rico, Foreign Student and Scholars, Military, International. We're going to focus on Basic. The Basic is standard deductions, no itemized deductions, wages, salaries, and tips, tax exempt and taxable interest, qualified and ordinary dividends, IRS, pensions, annuities, if the taxable amount is determined, Social Security benefits, charitable contributions, child tax credit, earned income tax credit, penalties on early withdrawal of savings, child and dependent care, and premium tax credits, or some people only know as Obamacare. Now we're going to talk about the filing basics. That's important. And there is a training that has been done on the intake, interview, and quality review sheet. This will help you, as I said earlier, to prepare an accurate return. That form is the 13614-C. And then you're going to look at all the supporting documentation. All taxpayers, quality reviewers, instructors, and site coordinators, we all have to pass that intake/interview and quality review tests. Now, then due diligence. I'm going to ask you a question here. If you are clarifying, this is a young man named Stephen, and Stephen has a 13614-C, the intake form. Stephen is at one of your sites to have his taxes prepared. He's completed the form and he tells the taxpayer, preparer, that he is 22 years old. He has two sons that are ages 10 and 11. Now, mind you, he's 22. He has Social Security cards for both the boys and himself. His W-2 wage indicates earnings of $20,000. Now, do you think that it's safe to rely on the good faith for Stephen's information? I know most of you said no. I know you did, because if it's yes, you're saying Stephen's information seems okay. But I know all of the attendees here definitely said no, that you're going to need further inquiry. Now, filing basics. You must file a return if any of the conditions below apply for 2021 tax return. You owe any special taxes, including any of the following. Now, some of these are out of our scope, but we're just letting you know, but that we cannot do them. The alternative minimum tax, out of our scope. Additional tax on qualified plans, including an additional retirement arrangement or other tax favored accounts. Household employment taxes, out of our scope. Social Security and Medicare tax on tips you did not report to your employer, or on wages you received from an employer who did not withhold these taxes. Recapture of first-time home buyer credit. If you purchased your home, I think it's like 2008, and you received that first-time home buyer credit, you have to repay that money at $500 generally until it's paid off. Write-in taxes, including uncollected Social Security and Medicare, or RRTA tax on tips you reported to your employer, or a group term life insurance and additional taxes on health savings accounts. You or your spouse, if filing jointly, receive HSA distributions, health savings, and that is in our scope. If the archer, that's out of our scope. Medicare Advantage, that's out of our scope. Say you had net earnings from self-employment of at least $400, you would definitely have to do a tax return. If you have advance payments of the premium tax credit are made to you and coverage through the marketplace, you'll have to prepare those taxes. Even if you have a zero income, if you receive the premium tax credit, a tax return has to be filed. They will receive a form 1095-A, which will show the amount of the advance payment. If they do not have that information, we need to hold up and ask them that they need to bring it back, because we cannot submit the return without it, because it'll come back to us as rejected, or it's going to hold up your refund. So we ask for that. Now, who should file? There are a number of reasons why you should file. You see the list here. You can go through them. I'm not going to take, to waste your time to go through them. What I want you to read through that list. But now remember, regardless, if you think you might be receiving the earned income tax credit or even the child tax credit, regardless of your income, you should prepare a tax return. You never know what credits you might be eligible for. All right. All right, let's have another question here. Now, Andrew is 22. He is a third year college working. He's in third year of college. He's working towards his undergraduate degree in accounting. Now, Andrew's parents provide for his tuition and board costs and also for his other expenses. Andrew has a part-time job. What does Andrew's earned income need to be for him to be required to file his own taxes? That's a question that I'm going to have another slide, but I know a lot of you may already know. Let's say $12,550. The filing statuses, very important. Everyone who files a federal tax return must determine which of the 5 filing status options apply to them. Single, married filing joint, married filing separate, head of household, a qualifying widower with dependent child. Okay, another question. Josh is 33. He's in his third year of college working towards his degree in chemical engineering. Josh's son, Braden, is 4 years old and lives with him all year. Since Braden's mother passed away 3 years ago, Josh's mother, Alicia, helps taking care of Braden while Josh is in class and helps with some of his expenses. They're not more than half the cost to support him. No more than that half the cost. So what do you think would be the correct filing status for Josh? Would it be single, head of household, or qualifying widower? What do you think it should be? Head of household. I know you all got it right. Let's talk about this tax return. All right, there are rules for claiming a dependent. There are tests that you can determine whether it can be your qualifying child or your qualifying relative. A child must be your son, daughter, stepchild, foster child, brother, sister, half brother, half sister, all right, even adopted. There are a number there. Say that it's a qualifying relative. That person can't be your qualifying child, of course, or the qualifying child of any other taxpayer. The child isn't the qualifying child of any other taxpayer if the child's parent isn't required to file an income tax return or files an income tax return only to get a refund of income tax withheld. A dependent. The child must be under age of 19 at the end of the year and younger than you or your spouse if filing jointly, under the age of 24 at the end of the year, a full-time student, and younger than you or your spouse if filing jointly, or any age if the child is permanently and totally disabled. The child must live with you for more than half of the year. Now, qualifying, let's say now we're going to talk about a relative. The person either must be related to you in one of the ways listed under relatives. They must live with you all year as a member of your household, and your relationship must not violate local law. The person's gross income for this year must be less than $4,300. All right, which of the following is the correct formula for calculating taxable income for an individual taxpayer? Would it be A, the gross income minus exclusions, adjustments, and itemized deductions? Would it be gross gross income minus adjustments equal adjusted gross income minus greater of itemized or standard deductions and qualified business income deduction. C, gross income minus standard deduction. D, adjusted gross income minus adjustments and itemized adjustments. All right, we all know that's going to be B. How do we calculate our taxable income? All income from whatever source, all right? Then you're going to have gross income, less deductions from adjusted gross income, less charitable contributions if a standard deduction is taken. Because there is a new rule. Now, if you're filing a tax return and you're taking the standard deduction, you can claim up to $300 for a charitable contribution. Adjusted gross income, less the larger of the itemized deduction or the standard deduction, less the qualified business income deduction. That is now going to give you the taxable income. These are the different taxable incomes that you're going to see here. They go from wages to canceled debts, annuities, employee bonuses, jury, IRS distributions, hobby income, gambling winnings, gain from the sale of a property or securities, military pay, military pension. You're going to see the list of rent, royalties, civil service, Social Security benefits. Now, this will be available for you later to go over and review, and then you can take your time and go through all of the taxable incomes. Non-taxable income, aid to families with dependent children, the AFDC. A lot of people think that they can prepare their taxes with that. I'm sorry, you cannot. Child support, you cannot. It is not a taxable income. It is an obligation. Civil damages, damages for physical injury, death payments, economic impact payments, employer reimbursements for ordinary or necessary actual expenses, federal income tax refunds. That's not an income. Insurance proceeds, Olympic and Games medals and prizes. There are a number also this, like I said, it's going to be available. So you can always go back and review the the recording, and you'll be able to see the non-taxable income. All right. I'll just pause it for just a minute so you can see it. And now unemployment income and the American Rescue Plan Act. The Plan Act was initiated, it started in March of 2021. Now, normally unemployment income is treated as taxable income. Those receiving unemployment income should be encouraged to automatically withhold taxes or make estimated tax payments to the IRS to cover their tax liability. What happened was under the ARPA, taxpayers receiving under $150,000 were able to exclude $10,200 single, $24,400 if married filing joint for those benefits. Adjustments to your income. Self-employment income and tax, penalties on early withdrawal of savings, alimony paid only if the divorce of separate maintenance instruments were executed on or before December the 31st of 2018. Contributions to a traditional IRA or HSA, student loan interest, jury duty income repaid to employer, educator expenses, cash charitable contributions up to $300, as I was telling you, if you're doing a standard deduction. Now, standard versus itemized deductions. Now, here is the threshold for the tax year of 2021. The standard deductions for, you're going to see for the single is now going to be $12,550, married filing separate, $12,550, married filing joint, $25,100, head of household, $18,800, and qualifying widower, $25,100. Yeah, standard deductions. Taxpayers who cannot take a standard deduction and must itemize are: if you are married filing separate and your spouse itemizes, you have to itemize. If you are non-resident or dual status alien, I hate that word, I'm so sorry, not married to a US citizen at the end of the year, you have to itemize. A standard deduction is higher for a taxpayer or a spouse that's 65 or older, or if one or both spouses are blind. A lower standard deduction is offered for an individual who can be claimed as a dependent on another person's tax return. Say you had an income, you don't have to file taxes. Your parents provided over half of your support. So when you fill out your intake form, there's a question there that's going to ask you, can someone else claim you as a dependent? That person would check yes. Then you as the preparer know that you have to indicate that on the tax return, because it is going to give them a lower standard deduction. Itemized deductions. You can itemize medical and dental expenses for the taxpayer and the spouse and dependents. You can deduct state, local, and foreign real estate taxes are reported on the Schedule A. Everything for the itemized deductions goes on your Schedule A. Deductible interest is reported on Schedule A. Qualified gifts to charity, casualty and theft losses, other miscellaneous deductions. Now, question, which of the following expenditures do you think that you can itemize with? A, property taxes. B, charitable contributions. C, that you cannot use as a charitable contribution, a charitable deduction. You cannot use it. I was wrong, sorry. You cannot use it as a charitable deduction. C, mortgage interest. D, self-employment taxes. I know I've got a brilliant group here. I know you all said D, self-employment taxes. You definitely cannot use that on to itemize. Some of the tax credits. Now, as I was telling you earlier, the American Rescue Plan, or the ARPA, is one of the several legislations that was enacted to amid the COVID-19 pandemic. There are various forms of economic relief that was given: the stimulus payments, tax provisions, expanded unemployment benefits, and more. And some of these changes are going to be retroactive. So they're going to be available for the 2021 tax returns. So we'll all have to keep that in mind. Now, you know there was the stimulus payments that were issued by the government to help Americans throughout the pandemic. As we all know, the payments there were three payments. There was $1,200 per individual, $500 for children 16 and under, $600 per individual, and $600 for children 16 and under. And then it was $1,400 per individual, regardless of the age. There is still the opportunity to get that. When we prepare your taxes for the 2021 tax return, we will be able to do the recovery rebate tax credit so that you can still get those stimulus payments. So as they say, hope is still alive. All right. Now, the federal earned income tax credit, the EITC, is a unique tax credit that puts money back into the pockets of low and moderate income workers. There are some changes to it. There is another recording that's going to training that will tell you what all the updates are for the tax season. Now, the update for this one very quickly, the EITC, now it has been lowered. It is over the age of 19, unless you're a full-time student. And the maximum age used to be 65. That's been eliminated. Now, when you're preparing the taxes, we were allowed to do it last year. Keep in mind, because incomes were different. So the IRS allowed us to go to the 2019 tax return to look at what their EITC was. If it was greater than we calculated for the 2020, we were allowed to use the 2019 amount. They're going to allow us to do the same thing for 2021. So please keep in mind, ask the taxpayer if they have their 2019, and we're going to ask people to bring it, the 2019 and the 2020 tax return, because that may benefit them. So just a little extra step you might have to take. Now, in the past, if you had an income that was an investment income that was $3,650, you were not allowed to take the earned income tax credit. That has been increased to $10,000. And it has, so there are more people, hopefully, that will be eligible for this benefit, this earned income tax credit. Now, keep in mind the word earned. It has to be earned income. They cannot use their pension. They can't use Social Security, unemployment, any of those. It has to be earned income. Years ago, the government felt like it was an incentive. If you have a job and you have children or even no children, I'm going to give you an incentive. I'm going to tell you, thank you for working. And we're going to try to give you extra money. Well, it is helpful. If you look here, you'll see the earned income. The first one here, the chart, will give you what the income should be. There is a limitation now, all right? But it's going to tell you here on the chart. And then the second part of it is the maximum EITC for 2021. So just think, if a person had 3 or more qualifying children, they may be eligible. I say may be because we have to calculate. Don't, let them come in and tell you, I'm getting X amount, XYZ. No, let me calculate it first. There's a possibility they're going to get an additional $6,728. And during these times, that is most helpful for families to pay mortgages. They pay back rent. They school, supplies, uniforms. They go back to school. So there are a number of things that this helps. Now, the advanced premium tax credit. Those who purchase health insurance as through the marketplace, and some people say Obamacare, if they come in and they have to bring a form 1095A, we must indicate in the tax return and put the information in the return of how much they were paid out on a monthly basis. As I was saying earlier, if they do not have that form, you need to hold up, because there's no way we can proceed without it, because it's either going to come back and the person is going to end up coming back to us saying that, they received the letter and it has to be done. So that's why we're going to try to do it in the beginning. So now these advanced premium tax credit payments, say if you changed your income during the year, it's a possibility you may owe, and it's also a possibility that they may owe you something. So that's why we have to report that. Now, the child and dependent care credit. This is also known as daycare credit. If you have a child that's in daycare, they would need to bring to you the the invoice from the daycare center, which has their information, because you have to put that in the system. The name, the address, their phone number, all of that you have to put in, and the amount that they spent. Now, In the past, it was only $3,000 for one child. That's been increased to $8,000. It was $6,000 for two or more. That's been increased to $16,000. And some employers provide a child care assistance. There was an exclusion that it was up to $5,000. That has been moved to $10,500. This credit is going to be calculated and it's going to be reported on a form 2441. Education credit. The American Opportunity Credit is available for the first 4 years of college per eligible student. The credit covers 100% of the first 2,000 and 25% of the second 2,000 of eligible expenses, up to the amount of a tax or a maximum of $2,500. 40% of the credit is a refundable credit. So it's got two parts to it. Part of it's a credit, part of it's refundable. Now, keep in mind, this is the best one. It will allow you also to write off books if they were purchased from a bookstore. And if you had to purchase a laptop, a computer, a tablet, those things are allowable. First 4 years of college are eligible. Now, lifetime opportunity, grad school, barber school, any kind of trade school. Then you're going to apply for the lifetime opportunity credit. This credit is 20% of the first 10,000 of eligible expenses. And it's going to be up to amount of a maximum of 2,000. This credit is non-refundable. And the students, you do not have to be required to at least be enrolled half-time. And it does not have to be a degree program. And a felony drug conviction is not a disqualification. Those things now do apply to the American Opportunity. Now say Josh is 33. He is a third year of college. He's in his third year of college. He's working towards a degree in chemical engineering. He currently pays $5,000 a year in tuition and fees, plus $1,000 a year for books purchased from the university bookstore. Now he will not be claimed as a dependent on anyone's return, and this is his first degree. Can Josh claim both education credits on his return? Where's my group? I know you said no. You're only allowed to claim one. Just one tax credit at a time. All right. So now, So now which one do you think he should claim? Should he claim the American Opportunity Credit or the Lifetime Learning Credit? Right, that's right. Since he's in his first year of college, working towards his degree, first 4 years, he should definitely claim the American Opportunity Credit. That one is a credit, plus it's a refund. Now, the child tax credit. This is a tax credit for eligible taxpayers with dependent children. That age has been increased to 17 and under. Now, in the past, a portion of it was non-refundable and a portion was refundable. The child tax credit will increase from $2,000 to $3,000 per child for under age 17. And if the child is under age 5, I don't know why they just don't say age 6. I don't know why they just don't say 5. The benefit actually increases further to $3,600 per child. A portion of the child tax credit was non-refundable. Now it's fully refundable. Now there were advance payments, child tax payments that were given out, but keep in mind, a lot of people think it's extra money. It is not. They just received half of it in advance because they felt like because of the pandemic, it would help families to pay some of their necessary expenses. We have no idea, a lot of you do not realize how many children did not have meals during that pandemic. So that's why they try to help families to get this extra money into the household. This is just a quick comparison table, things we've already talked about. But a couple of things I will point out, all right? In the past, you had to have an income of $2,500 to qualify for the refundable part of the credit. Well, now there's no income requirement. Those with a zero income can qualify for a full credit amount per child. So I just wanted to point that out to you, that they don't have to have an income amount there. Who is eligible? There is no minimum income requirement to claim the new child tax credit. All right, so we're just going to go on from there. Now, taxpayers that have an identification number, this is we call the I-10. It's an individual taxpayer identification number. A lot of people cannot get a Social Security number, but they can apply for an I-10. I-10 holders are also eligible for the child tax credit, but the child must be considered a qualifying child. The relationship must be your child, grandchild, stepchild, adopted child. The child must be 17 or under. The child must live with you in the US for more than half the year. Now, keep in mind, even if the parent has an I-10 number, the child must have a Social Security number. They must have a valid Social Security number. And the child cannot provide more than half of their own support. The child definitely has to be on their return as a dependent. So keep that in mind, please. But make sure now, child has to have a Social Security number. The parents can have either a Social Security number or an I-10 number. There's also, they came up with a credit for other dependents. This is a new credit that started back in 2017. It's up to $500 for other dependents who do not qualify for the child tax credit. They have to be a US citizen, a US national, or resident of the US. The dependent must have a valid identification number. They can have an A-10, I-10, or a Social Security number. All right. And now there is a disallowance for certain refundable credits. There's a form 8862 that sometimes people in the past have filed for an earned income tax credit, and it was disallowed for whatever reason. They will allow us to use this form 8862. We fill that out and submit it with the return. And hopefully they will go ahead and process their earned income tax credit, their EITC. Now, if the IRS determined the taxpayer claimed the credit due to reckless or intentional disregard of the rules, we won't be able to use that form for at least 2 years. All right, but say the error was due to fraud, then we can claim, and they can't claim the credit. If the error was due to fraud, they can't claim that credit for 10 tax years. So we'll need to ask them when they come in and it comes back at a, when we find out, it's generally a reject we get, and it tells us that they were not eligible. We have to contact the client back, we'll ask you to, and then you're gonna ask them, for what reason was it? Was it due to a fraud? Because apparently they're not accepting the 8862, so it has to be something else to it. So, other taxes, self-employment tax, Social Security and Medicare taxes, additional taxes on IRAs. And then we're going to, same thing, repayment of the first-time home buyer, healthcare, and those are all on separate forms. The advanced child tax credit payments we talked about, that's the payments that they received in advance. They were through the month from July until the end. The last one is in December. We have to calculate that on their tax return. We'll have to make the adjustment there. because like I said, it wasn't a credit. It was just a little extra money they gave. Now, I don't know how I got my tax scams in here. I guess I do. Well, let me really quickly go over with you. There are tax scams. They always try to prey on the elderly. So if they come in and some people already have a PIN number, identity theft protection PIN number. They must bring that PIN number with them because the return will not be processed. There is a question that's on the intake form that will ask them. And when you go over it, you need to ask them for that PIN number. It's generally issued a new one every year. But say someone comes in and they do have a problem with identity theft, then there are 2 numbers here that we can provide to them. And you'll have this information will be given to you. Now, this is the time there are any questions, but I guess we're not. We're recording it. This was for the other group. But this is our flyer. And on that website I told you about, these are the flyers that are there, and they're in 7 different languages. I'm Tanya Johnson, and there's Eddie Eduardo. We're the 2 VITA program specialists. And I wanted to very quickly see if I can, there is a proposed tax return. It has not, it's a draft. It has not been completed yet, but I think we'll probably try to send it out for some people if they want to see it, but there is a proposed draft return. So I'm making sure that I think I've covered all of the areas, and I need to look at my time. Am I over time, Eddie?
Oh, keep going. There's
Okay.
no problem.
Okay. All right. On the tax return, of course, at the top part, you've ever done taxes, you're familiar with it. We talked about the filing status. We've talked about entering the information there. Oh, okay.
Want to switch screen, Ms. Johnson, where for the other one, because we're still on the
thank you.
Yeah. Or do you want to, or do you have on a separate
No, I'm just going through. Yeah. Let me see. Wait a minute.
for the 1040 talking about?
Yeah. Let me do this real quick. There it is. Can you see it?
No. You have to minimize the PowerPoint.
Can you see it?
If you minimize the PowerPoint, or maybe you got to go back to the share screen.
Yeah. Wait a minute. Let me come out of the PowerPoint. Okay, let me do it one more time.
Yeah, I'll pause us for a
There.
second. Okay.
Can you see it now?
Oh, there you go. Yep.
Okay. Tell me when I can go.
Go ahead. Mhm.
That too big? Okay. All right. As you can see here, this is the draft form of the 2021. You see it's across the top of the filing statuses. We talked about those. So you'll be able to indicate, make sure that you're going to look for that. You're going to look at the intake form, and you're also going to talk to the taxpayer. So you'll know which one of these you're going to check. You're going to, of course, fill the information out here. That information that you're going to put in with their name is going to come directly from their Social Security card. That is because the IRS cross-checks with Social Security Administration. If that information does not match, then they're not going to be able to identify the person. So you have to get the information just like it. So if there's a misspelling on their Social Security card, unfortunately, you're going to have to misspell it on that tax return unless they have already corrected it with Social Security. And then that Social Security number, you're going to get that from the Social Security card. All the information here as far as that. Then here is, now this is a new one. At any time during the 2020 2021, did you receive, sell, exchange, or otherwise disclose any financial interest in any virtual currency? You're going to indicate yes or no. All right. So if they had the Bitcoins or the other, you have to indicate that now. This is the standard, next to standard deduction. Now you're going to indicate, it's going to ask you, can someone claim you as a dependent? Can someone claim your spouse as a dependent? You need to indicate that. Age, if you were born before that, before January the 2nd of 1957, if you're blind, if your spouse, please check those boxes. We should be able to look at the intake form and talking with the client that we'll make sure that we check those boxes. Now the dependents. These are the dependents that live with you. And make sure, as we've been through the dependency rules, that they are your dependent, that you provided over half of their support. They resided with you for 6 months or more. Only one person can claim a child at a time. So you can't claim them and the spouse can't claim. They need to make that decision ahead of time, but only one person can claim that child. Also keep in mind, if the child has a small part-time job, they didn't earn up to the maximum of $12,550, we might be able to, maybe now, because you have to do the tax return to find out, because you don't want to put that dependent in a bind where they may owe something. Because remember, when they click that they're dependent of someone else, they don't get the full amount of the standard deduction. They're not going to get the full amount. So we have to be conscientious about that when we're doing it, all right? Box 1, the wages and the salaries. We've already talked about what the wages might be. That would come directly from your W-2, all right? There's a tax exempt interest. They should have their bank statements or taxable income, the qualified dividends, the ordinary dividends. They should have the information there with them. The IRA distribution, they should have something there. Pension and annuities, they should have that. Social Security benefits, they'll need the Social Security. It's SSA, I think it's 1099. They should have that with them also. Now, also keep in mind, a lot of people may ask you, if you receive, generally Social Security is not taxable, but if you receive other income, such as wages where you're still working or pension, a portion of the Social Security may be taxable. So if that pops up and they question it, then you can let them know that a portion may be taxable and they can actually go under Social Security, SSA.gov, and they can verify it themselves. Now there's line 7, capital gain or losses. We're going to attach a Schedule D. The forms are in the system. And when you go to, you input it, and it's going to carry over to this 1040. All right. Then there's other income. The adjustments to the income, we've covered that. After that, we're going to come to your adjusted gross income. This form has been changed from last year, so I want everybody to keep in mind. Now you're going to put in your standard deduction or your itemized deduction, and you're going to use the Schedule A. But now, keep in mind the standard deductions are $12,500, $12,550, all the way up to 20,000 something. Keep in mind now, their standard, if they're going to itemize, they need to itemize greater than the amount of the standard deduction. I mean, we try to tell people they'll come in with an itemized list, but your standard deduction is actually higher. So we recommend that you take the standard deduction and not itemize. Because if your standard deduction, say, is 18,000, whatever, okay? And you have an itemized list with you that only comes up to 14. you're cutting yourself short, because that is actually going to help you with your taxable income, because the greater the amount is going to have a less of a taxable income, which means you're not going to owe taxes. It's going to be a lesser amount for the taxes owed, your tax liability. So it's all going to trickle down. Now, charitable contributions, 12B. If you're doing a standard deduction, remember, you can write off up to $300 with the standard deduction. All right, then the qualified business income deduction. This is for people that are self-employed. Now, then you come to, after all of that, line 15, you're going to come to your taxable income. Now, that taxable income is going to help determine how much your tax is going to be. It's going to tell your tax liability. So that on the next page on line 16, it's going to calculate what your taxes are that are owed. Now, there are amounts that are still might be deducted from it. You're going to, any amount that was originally carried over that you did an input that went over to the Schedule 2, that's going to be deducted. The non-refundable child tax credit or the credit for other dependents, that's going to be deducted. And then whatever amount went to line 3, that's deducted. After you subtract all that, and whatever the taxes that might be, including your self-employment tax, then that's going to come up, and that's going to tell what your total tax is going to be. Most times it's not going to be the amount on line 16, because all these adjustments have been made in between. All right. So then you go to line 25, the federal income tax withheld that comes from your W-2. It's also, when you input the information on the W-2, be very careful, double check all of your numbers. The EIN, or the employer identification number, please make sure that you put the number in that's from the W-2. Some people make a mistake and they put in the Social Security number. Please double check yourself and make sure that you put in the EIN number. All right, that is really important, because we're getting problems there with people that are filling in the wrong number. All right, so then that amount of the federal income tax withheld that you put into that form, that information, it's going to carry over to this 1040, and that's going to go on line 25A. Now, if you had a 1099, if you were self-employed, there are 2 of them. It's a 1099 miscellaneous, and it's a 1099 NEC. If by chance any taxes were withheld, when you input that information on that form, it would carry over to 25B. Or if there are any other taxes that were withheld somewhere, that would carry over to line 25C. You're going to add up, they're going to add up line 25, all of them. They go into the total amount is going to go in line 25D. Now, at this point in line 26, say you had some estimated tax payments that were that you applied from your 2020 tax return, not you, but the taxpayer. That information would then carry to line 26. And also line 27, your earned income credit, or your EIC, goes to line 27. We talked about the earned income tax credit. Now, we don't do military returns, so you're having the 27B, it's probably no. 27C, the earned income credit. Remember, we talked about that the IRS will allow you, if it doesn't match what's on 2019 tax return, we can use that amount. That carries over to line 27C. prior year 2019 earned income. So that would go there. Then 28, refundable child tax credit or additional child tax credit would carry over from the scheduled 8812 to there. The recovery rebate credit. Remember I told you Hope was still alive? If you didn't get the stimulus payments, then you can make sure that that taxpayer will be able to get their money. They have to be accurate to tell you, did they receive the 600? Did they receive the 1200? Did they receive the 1400? When you put that information in the system, it's going to carry over here into line 30. Now you're going to take the amounts from, if there's anything on the Schedule C that goes there. All of this information is going to be, it's going to calculate, and on line 33, that's going to be your total payments. It's all your credits and your payments are right there. So what you do then is you're going to go, well, the system is going to do it for you, really. They're going to take line 24, your total tax. They're going to subtract everything from line 32, all your credits and refundable credits and whatever payments were made. And it's going to give you your total pay. Well, I'm sorry. That's going to give you the amount of line 34 that was overpaid. Hopefully we'll all be overpaid and we're going to get a refund. But that's how it kind of tell you how it works. And this is a draft form. I'm thinking it's not going to be changed, but please keep in mind, like I said, it's a draft form. Now, if the person, if they want to have a direct deposit, we ask them ahead of time to bring in information. They need to bring in a canceled check, we ask them, that will give us their routing number and their account number. We try to push for everyone to do a direct deposit because it is safer. The money gets there faster and you don't have to be walking around with that kind of cash on you or going to one of the check cashing places to have your, to get your check cashed and pay a fee. We were trying to make sure that you get all of your money in your pocket. All right. If you decide, you can even have a portion of it applied to your 2022 estimated tax. But that amount that's owed to you, we're hoping that we're going to ask everybody, please ask them if they would consider doing a direct deposit. A lot of people, for whatever reason, don't, but that's fine because that's their personal choice. All right. So I think we've covered everything. I want to thank you for listening to me today. I hope that you will review this training again. And like I said, if there are any questions that you do have, please feel free to call us at our number, which is 240-777-1123. As soon as we receive the training materials, Mr. Mendez will let you know, and that you'll be able to come into the office and pick up some of the training books. So good luck on your test. I know you're all going to pass. So we'll see you at tax season. Have a great day.
Thank you, Ms. Johnson. One other thing to add it to the end right there for the material, we also will forward it to your address. So make sure we have the correct address. All right. So thank you once again to Ms. Johnson Benoit for today. This concludes our training for the basic scenario. And this was a very, very, very well throughout training. Thank you, Ms. Johnson. And this is it. Back here. Let me stop.